Hello and welcome to the 200th episode of our Do More With Your Money show. It's quite hard to believe that we're already at episode 200. Today what we're going to do is we're going to look forward to 2024 from an investment perspective, but also look back at some of the challenges that markets faced in 2023 as well. I'm joined today by a number of the investment management team to do that. We have got Kevin Kidney, one of our investment directors, Paul Durrans, investment director, and Chris Leyland, director of investment strategy. So let's get into it and let's look at some of those key things that through Morning Markets and our other podcasts through the year we've been discussing. But let's look forward to 2024 in the first instance and really think about where we're going. And one of the key themes that we've had to deal with through 2023 has been that disinflation, that falling inflation backdrop. And Kevin, maybe you could start there and just bring our listeners really up to speed on where we are and how we think about inflation or disinflation for 2024.
Absolutely. So disinflation is a theme that many of the portfolio managers have been running for the majority of the second half of last year. Disinflation was a theme which captured markets, or certainly captured consumer prices. Inflation had peaked in most economies in 2022. So this meant the growth in price pressures was slowing. It's not a fall in price pressures, but certainly as we got towards the end of last year, markets became more surprised by the acceleration in disinflation, such that the latest vintage of inflation prints we've got from most major economies, the UK, the Eurozone and the US, are close to zero on a monthly basis. And this tells us that, the inflation momentum has slowed dramatically, and that perhaps over the next 4 to 6 months we're going to see further substantial declines, both in headline inflation prints, but also in a number of core measures, these stickier measures which exclude those volatile elements such as energy and food. And it's not necessarily a synchronized move down. The US has led, it's got the broadest disinflation, and it's the UK that's lagging, but the UK is likely to catch up quite aggressively. That is, inflation in the UK will probably fall very substantially into the spring. And if we take it all together, it's going to be a real challenge for policymakers, central bankers, to justify the current level of interest rates, given that we may see inflation begin with a 2 in most major economies.
And it would be fair to say that brings those inflation readings much closer to, if not in some instances below, where central bankers have wanted them to get to in terms of target inflation levels.
And one such example of the challenge ahead is the Federal Reserve give a quarterly estimate or a projection of where long-run inflation will get to. By 2026, they think inflation will be back to 2%. Our estimates are that we could get there as early as April, May this year. So well over 30 months ahead of schedule, the Federal Reserve may have to acknowledge they have inflation back to target, but they will then try and condition markets on whether it's sustainably back to target.
And that probably suggests it's a very delicate balancing act for central banks to really communicate that narrative to the market, but also the difference in expectations, as we can see, between what the market thinks for interest rate reductions in 2024 versus what maybe some of the central banks want to bring to the table as well.
And the conundrum remains employment markets are so healthy that whilst on one side they're looking at falling price pressures and slowing inflation, on the other side, the typical economic weakness they would expect to see that feed through into employment markets hasn't come. Even in the UK, where we've got the slowest GDP impulse, we've not really seen any material weakness in headline employment.
And maybe, Paul, just to bring you in on that point, and we've talked about inflation, interest rates moving up aggressively was the way central banks were dealing with it, as Kevin said, inflation normalising. How should we think about that in terms of interest rates and the potential for changes there as we look to 2024?
Yeah. So if we think about where we've come from for over the last 2 years, we have seen significant increases in interest rates in the developed and emerging markets or regions. So in the UK, we have interest rates at 5.25%, the US 5.5%, Europe 4.5%. But as Kevin discussed, inflation is now trending much closer to that 2% target level, and therefore the market begins to expect that interest rate cuts should come going forward in through this year and into next year as well. And that's been signposted by central bankers, Federal Reserve. We had the minutes yesterday from the last meeting in December, that interest rate hikes are no longer and that we can expect interest rate cuts. So the Federal Reserve, they provide their projections. They're expecting 3 interest rate cuts in the US, so 3 0.25% cuts this year. The market's expecting much more. So the market's actually pricing in 6 0.25% cuts. And that's on the basis that we're seeing slightly softer economic data come through more recently over the last 8 weeks, and also just inflation not only trending lower, but coming in below consensus estimates. And that's been very supportive for asset prices, which we'll come on to. So we've seen strong returns in both equities and bond markets. But the question for us is how have there been too many interest rate cuts being priced, given that economic growth, particularly in the US, is still very strong. And as Kevin points out, employment markets are still...
I suppose that is a bit of an anomaly that we've got at the minute, that you would be expecting significant interest rate cuts in more of a recessionary environment. That would be typically what we have seen historically, whereas that doesn't look to be the data that we're seeing at the moment, particularly for the US.
And that's just the challenge for central bankers, that inflation's coming down, so typically you cut interest rates, but not when you've got employment and economic growth so strong.
And that probably gives rise to that term that we've heard of a soft landing for a large part of the global economy. And maybe just it's a word that we use quite readily, but what should our listeners think about what does a soft landing actually mean?
Yeah, sure. I mean, if you think of maybe outside of finance and you think of a metaphor for a soft landing, what do you think about? We probably think about a plane coming into land and landing successfully. Now, how do you then translate that? I can see you smiling at me saying that.
I'm just hoping that most planes land successfully.
So how do you translate that into finance? So you translate that by saying what you have is central banks looking to deliberately slow down the economy. And a soft landing is that they do that, and they do that whilst avoiding recession. So firstly, why are central banks looking to deliberately slow down the economy? Well, it's because you've had very elevated inflation levels, and what they're trying to do is to cool the economy, to bring inflation down to...
Which we know they've successfully achieved. And so it's that engineering of that outcome effectively as to where we are today.
Absolutely. I mean, I'm going to go back to my plane analogy here, which may or may not be working. I can see you laughing again. But, when you're landing in a plane, obviously you've got to navigate the conditions and you've got to land that plane successfully. But for the slow landing, again, what a central bank has to do is to navigate the conditions in the economy overall, to make sure that they don't slow things down so much that actually you start to see a recession come through, that you start to see a significant increase in employment overall. And that's what has been happening over the past months, years, with central banks actually trying to bring down those inflation.
And that's probably the narrative that we have to sort of navigate this year and try and discern from what central banks are saying, that if they move too early, they move too late, there could be very different outcomes for the economy. And one of those areas which I suppose has surprised all of us in terms of its resilience has been the employment backdrop, the strength of the consumer. Globally, one would argue, maybe with the exception of some parts of Asia and China in particular, but is that normal that the consumer and the employment market has been as robust at this point in the cycle, Kevin?
I think no. If we compare it with where we were pre-global financial crisis, we have a very different consumer. So going into the COVID shock, it's now acknowledged that the global or the Western consumer was probably under-levered. They weren't that exposed to a material shock to house prices or to rising interest rates. And that's fed through in that many central bankers are somewhat confused by how insensitive consumers have been to rising interest rates, but also estimates of how much savings the average consumer had to hand through COVID continue to be revised up. So we've had a material shock to prices. Consumers have had to dig deeper to fund their lifestyles, even just basic non-discretionary spending. and yet savings appear to be much higher than were considered even 12 months ago. And the third component is that nominal wage increases are still quite sticky, and with rapidly falling inflation, it suggests that the real income component for the household or the consumer is actually positive, particularly in the US, but could soon be in the UK as well. So under-levered, underexposed to interest rates on the liability side, excess savings are higher than we thought, and also rising real incomes. It's a very healthy, forward-looking perspective for the average consumer. Now, there's huge differences in different cohorts, but this is one of the reasons why GDP, mainly in the US, has remained so healthy. The consumer there in particular is in a very strong place and appears more savvy about price rises, orienting spending towards parts of the economy which are seeing low price rises, or even some parts of the market where there's actual fall in prices, such as in goods.
So if I was to sort of summarise some of those points and bring it together in terms of how we're looking to 2024, it's interest rates have peaked and now we should be seeing interest rate reductions. The magnitude of those reductions is probably the debating point. Inflation across many developed economies back closer to target, and the potential that central banks have managed to engineer a good landing, a soft landing for the economy.
They'll certainly take the credit. I think the central banks would be reckless if they didn't take credit for engineering disinflation. There will be a wider debate about whether inflation was in actual fact transitory. It was just a bit stickier. And also we had the Russia-Ukraine shock to energy prices. But definitely disinflation is very broad across countries, very credible. And there is room for further actual downside surprises in inflation prints as we go through the first half of the year, not just in the US, but in the UK and in Europe.
Okay, so the potential for a healthier economic backdrop coming through.
One could argue that downside inflation surprises are a form of tax cut for consumption-based economies, and that could be a healthy thing, particularly if in the UK we've seen a substantial fall in petrol prices, for example, and that does feed through very quickly into the ability to spend for the consumer.
So we've looked a little bit forward to 2024, and I wanted just to recap and also to think about 2023, just to round that out for our listeners as well. And Chris, maybe just in the first instance, if you could give a broad view of how equity markets have performed through 2023, given, as Paul was alluding to, that strength that we did see, particularly in the fourth quarter of the year.
Yeah, absolutely. 2023 was a good year for global equity returns. So maybe just digging a little bit into that and just thinking around that regionally. So the two regions that performed the best were Europe and the US. So the US driven in the main by 7 stocks. So something that I know we've discussed at length on the various podcasts that we have, which have been nicknamed the Magnificent Seven. So names like Nvidia, Tesla, Meta, Alphabet, Amazon, etc. within there. So what you saw, anything that had a strong linkage to artificial intelligence did really well over the year. Now, those 7 stocks on their own were up 74% in local currency terms, and they've been the key driver of what's been happening within US equities. So if you were to look at a US equity index, but to equally weight the sectors that are in that index, so not to have so much exposure to those big 7 stocks, then actually in local currency terms, the S&P equally weighted, what we call it, that finished up 14%. So you can see quite a big difference there overall. With Europe, what you've seen is particularly the banking sector has done very well. So European banks finished up over 30% over the year, again in local currency terms, driven by that higher interest rate environment overall. Just to keep it balanced, the region, and I think, Jeff, you did touch on this before, the region that didn't perform so well was China. What we've seen with China is it struggled with high youth unemployment, pressures in the property sector. And I know one thing that we were actually discussing ourselves as a group is, a lot of investors are waiting to see what level of potential stimulus, if at all, could come through from the Chinese government. What could that take? to actually get more people to invest back in China.
And certainly the other area of asset markets that brought a lot of talking points last year was the sovereign bond markets. And really it's quite amazing when you look at sort of that journey that sovereign bonds were on in 2023 in terms of the round trip. There's about a 10 basis point difference between where we started the year and where we ended the year on the US 10-year. But the journey between the times was quite phenomenal.
Yeah. So I'm going to build on Chris's analogy of a soft landing being an aircraft coming down at the front.
Great analogy.
And say the bond market last year was a roller coaster. And so you're absolutely right. If you owned the income component of a UK gilt, that is a bond issued by the government in the UK, that yield only fell by about 10 basis points, 0.1%. So you earned your coupon. However, it doesn't tell the story of what happened to the price of the bond or your total return. By the end of Q1 last year, your return was plus 6%. This followed the regional banking crisis in the US. You'd had a material rise in the price of bonds, so you sat on plus 6% total return after just 12 weeks. By the middle of August of last year, your total return had fallen to minus 5% for a variety of reasons, worries about inflation, worries about too much growth in the US and bond supply. So we'd gone from plus 6 to minus 5% in less than 6 months. Fast forward to the end of the year, we've gone from minus 5% to plus 5.5%. So the total return from a basket of UK sovereign bonds was 5.5%. And that actually matched the return you would have got from a basket of broad global sovereign bonds. So UK gilts actually performed in line with the global market. However, the volatility was at times quite remarkable. And that's a theme we've talked about through 2021, 22, but definitely the total return from UK gilts doesn't tell the story at all of the inter-quarter moves in the prices.
I think it's, you can look at that in terms of the yield levels, and if you think about getting the US context back to 3.3 or low and north of 5 in the midst of the challenges that we're seeing for the bond market, quite a remarkable journey, really.
Absolutely, and perhaps the most remarkable thing is that of that total return for gilts, and this is where it comes into staying invested, 100% of that 5.5% came in the last 14 trading days of the year. So you can have a 250-day trading year. However, it was just those November brought the bond market back up to flat on the year for gilts, and it was December where you saw the positive total return on the year. Really was a story about how we have to be able to look through volatility if we have a credible view and just stay invested.
And it also speaks to how narratives drive markets. If we think back 3-6 months ago, the narrative was inflation stickier, Fed are higher for longer, or interest rates globally are higher for longer. But then it's completely swung to, well, how many cuts can we now expect? And as you were saying, Paul, 3 to 6, depending on what way one wants to look at it.
Absolutely. I think volatility is very difficult for investors, for clients to deal with. And I think that's part of the reason why True Potential believes in diversification, investing for the long term, having goals, having active managers to manage your investments who are experienced on managing through more volatile time periods. But it is difficult, but you have to put faith in the people managing and having that long-term horizon, because the longer you stay invested, the greater potential you have for greater returns.
And a narrative is can be such a more powerful driver of returns than actual economic outcomes. To put it into perspective, for US Treasuries, December was the best monthly return in the last 30 years outside of any month which has seen rate cuts. So not a lot happened. It was just we had another surprise in inflation to the downside. We had a slightly better announcement to kick it all off with regards to how much or how many bonds the US Treasury would have issued through
and then
the quarter.
The Fed meeting.
And the Fed did confirm that the rate hiking cycle is over. But that just built this narrative which the markets jumped on, of disinflation.
And Chris, I'm just conscious of how we've talked about the returns there that have been seen in bond markets, albeit a very volatile journey. Equity markets as well, a volatile journey as well, if we look at certainly what happened in the middle part of the year. How did that translate into the True Potential portfolio solution and the returns that our clients were able to achieve?
Yeah, sure. So I think from our perspective, very pleased with the returns that we've achieved for the True Potential portfolio proposition for the year. Obviously, bonds and equities are the key components that make up the True Potential portfolios overall. So although it was a very volatile year, actually what you did see was good performance come from both asset classes. So maybe just to give you a few numbers, if we look at our most popular portfolio, which would be the True Potential Balanced portfolio, that returned around about 8% on the year, and that's after fund charges. If we look at the best performing portfolio, that would be the higher risk portfolio. So that would be our Growth Plus portfolio, which was up around 9.8% on the year overall. The defensive portfolio for our low risk investors was up around 4.4%. So I think, from my perspective, very pleased with what we've seen over the year. A lot of it's quite backloaded when we look at performance, because obviously we did see a big change in asset class returns in November and December, but overall a good year.
I suppose it also highlights the point that both Paul and Kevin have been making around staying invested, the challenge that volatility does present, and trying to time markets, which I think if we were to rewind towards the end of October, when there was the crescendo of noise and yields were peaking out at 5 and a bit percent, some people could have been decided to, I'm exiting the market at this point in time. What we're always very clear about is it's exceptionally difficult to forecast.
And also when markets turn, typically your cumulative total return is very focused into just a small number of days.
Yeah.
So you might have a very high return over the year, say equities, but they were big outsized days which contributed to that total return. So it's not just a saying staying invested, it's actually the way to meet your long-term goals is
the maths works.
Yeah,
from that perspective,
the
compounding effect working through. I wanted also then just maybe to turn a little bit to thinking about some of the events that we might want to focus in on as we go through 2024. And I'll maybe come to you first, Paul, in that regard. Around, there's a lot of elections when we look to the year ahead. How does that influence markets? Does it influence markets? How should our listeners think about that?
Well, it does influence markets, especially when you have a US election. This US economy is the largest in the world, and it has a big influence on markets in general, and that will come in November. So we're still 11 months out, and so it's a bit early days for it to start to have any influence on markets. But there's elections all around the world. We might have one in the UK, still depending on the time. So it will come into focus, especially as we get closer, and in the policies and what the candidates are standing for comes more clearer, and it will translate into volatility, or it has the potential to translate into volatility. I think it's very difficult to invest on an election because they can be very difficult to call, and often if you look at opinion polls, they can tell you one thing, but the result is very different. And there's a number of instances going back over the years, and perhaps 2016 stands out, with Donald Trump and Hillary Clinton, where Donald Trump was not expected to get in at all, but as that started to change as we got towards the date of the election, markets actually sold off. But then when Trump actually got elected, markets actually started to rally as tax cuts started to come through, and the potential for changes in trade agreements actually was muted or actually pushed out. So There was a bit of a relief rally, but there was volatility.
And I think that's the key word. It's the volatility.
Yeah.
And as we've talked about through last year, volatility is just something that we have to live with, something that can be navigated through.
Yeah.
But trying to, as you're rightly saying there, trade around volatility is exceptionally difficult and not something that we think is rewarded effectively.
No, and we don't. When we speak to our managers, I can't think of anybody that would trade around it.
Yeah. And Chris, maybe just given you've been close to the managers, ongoing discussions with them, how are some of them thinking about the year ahead? What their expectations are?
Yeah, absolutely. I think all of the managers that we work with are seeing a lot of opportunity as we look through this year, and maybe just to kind of bring out some of those examples. So maybe starting with equity markets, what you're seeing is some of our managers seeing the potential for a broadening out. So maybe a little bit of a move away from what we've seen this year, with maybe a bit less concentration in respect of what's been happening within the US, as well as that within fixed income. Obviously seen very big moves in yields so far, but managers are still willing to hold sovereign bonds. One area that they have been adding to that they've been finding quite interesting is high yield. So high yield bonds. I was just looking at the index before. I think the yield on that's around about 7.4% at the moment. So really the key rationale for that is just the very high levels of yield that you're receiving overall. But I think, looking forward, I always say this, and maybe it's the wrong thing to say, but there's always opportunity within multi-asset. The beauty of what we do within multi-asset is there's always an asset class, there's always a product, there's always something there that is interesting and has real potential. And that's exactly what our managers are looking for.
And Kevin, just maybe to take the other side of some of that, there's a market narrative around disinflation, soft landing. What could be some of the things that might upset that balance as we looked into 2024?
So I think disinflation is locked in the first half of this year. It would take something remarkable, severe shocks. Now, one such shock that some of our clients might be focused on is the troubles in and around the Suez and the rerouting of global freight. That's likely to be a minor issue in the short run. It could become a bigger issue in the medium term, but it's likely to have very little impact on inflation. I think the main difficulty will be in the second half of the year, when I think the disinflation theme will have run its course. Base effects from COVID and the Russia-Ukraine confrontation will have fallen out of inflation baskets, and we will have a very low inflation impulse, but that means inflation becomes very sensitive to shocks. Now, one such shock could be any further reduction in production of oil by the global oil cartel, OPEC. We saw in August and September that the oil markets didn't necessarily take it well when oil prices rise, and that does feed through very quickly into headline inflation, particularly in a country such as the UK, where our currency is also quite volatile. So where I think the second half of the year, there will be a big challenge to the disinflation narrative, which may not actually challenge asset prices at all, because most bond markets in particular still look attractive. And although there's a lot of optimism in equities, as Chris has mentioned, it's very narrow and focused mainly on those mega cap 7 names. So I think the base effects issue for inflation really has run its course by the summer and into the second half of next year. And inflation just remains as vulnerable to headline shocks. And of course, we're not really expecting inflation to fall materially below 2%. So it becomes much more difficult for central banks to justify rate cuts if inflation remains sticky above 2% with employment markets where they are. Yeah. It's a complete game changer if we have seen a real material slowdown in the US economy, for example, which is then feeding through quickly into employment growth.
But certainly that's not the base case at the moment. The base case is much more supportive of global growth remaining positive, and inflation trending lower back to target, if we want to think about that in a global context, and the consumer probably remaining relatively robust as we see employment markets so far unlikely to change significantly to the downside into 2024.
And many of the leading indicators we look for employment markets are showing a cooling, but not an actual reduction in headcount. There will be some at the margin, some job losses in some sectors, but remarkably, it's remarkable how healthy job markets are at this point in a typical economic cycle.
Thanks, Kevin, and thank you to Chris, Paul and Kevin for doing that show today, where we've went and looked at what's happened in 2023, but also identified some of the key themes and discussion points for 2024. Please do join us on our Do More With Your Money show and also Morning Markets, where we'll look into these issues in much more detail as we go through 2024.